Welcome to this week's Market Talk. I'm Amber Lancaster, and today I'm joined by Paul Mampilly and Ian Dyer. Each week we look forward to sharing our viewpoints with you, our readers, and giving you insight into what's on our radar. We're recording today's call on Friday, February 15th, because the U.S. markets will be closed on Monday, February 18th, in observance of President's Day. I'll begin by sharing with you what I'm watching, and then we'll hear from Ian and Paul. On the U.S. economic front, we are all a bit shocked by the fall in December's U.S. retail sales by 1.2% month over month. The print released on Thursday, February 14th, is recorded to be the biggest drop in retail sales since 2009. Taking this number at face value, we can say a number of turbulent factors were present in December to affect it so dramatically. First, we can attribute likely headwinds affecting this retail sales print were significant market gyrations during the month of December. As you can see in this graphic, the Dow saw massive daily swings in December, down 799 points on December 4th, 558 points on the 7th, down 507 on December 17th, and then up another 1,000 points more on the 26th. So overall, the Dow started December at a high of 25,826 points on the 3rd, then it plummeted to 21,792 points. So that's a decline of 18.5%, and we're thinking that this could have been a major curb on consumer spending. And you couple that with the government shutdown, which began on December 22nd, and we can see there's a probable cause for consumers to have closed their wallets as well. So based on this print, even falling gas prices appeared to have no effect on encouraging consumers to spend their disposable income. However, and this is a big however, economists do believe this downturn in retail spending is maintainable. It will not continue. And we could see a slowdown in retail sales continue through March of this year, likely due to after effects of the government shutdown, etc. But there should be a pickup in spending soon thereafter. Now, for the week of February 18th, we can anticipate the release of January's existing home sales, December's preliminary durable good orders, and January's Conference Board for the leading economic index. So economists are expecting January's existing home sales to climb slightly from 4.99 million homes to 5 million homes sold. Preliminary durable goods orders, which measures new orders received from over 4,000 manufacturers for items like cars, home appliances, semiconductor equipment. Well, for the month of December, we're expecting to see an increase from a prior reading of 0.7% to 1.7%. And the January leading index, which is a leading indicator that aims to forecast U.S. economic activity, is expected to increase from a prior reading of down 0.1% to an increase of 0.2%. Now, earnings continue to pour in for the week of February 18th for next week. So we're going to see earnings reports from Walmart, Devon Energy on Tuesday, CVS Energy, Transfer Partners, and Avis Budget Group will report on Wednesday, February 20th, and Bunge Limited and Kraft Heinz will report on Thursday, February 21st. And on the technology front, TechCrunch just reported that Uber Freight, a potential major disruptor in the trucking industry by helping truck drivers connect with shipping companies, has made 2 significant hires this month. Uber Freight hired 2 executives, one from Box and the other from Airbnb. The executives will lead global sales and the marketplace team, respectively. Now, Uber Freight is seeking to change the course of trucking by encouraging carriers and shippers to move in a new direction to attain their goals. So as it continues to scale up its app and plans for global expansion, Uber Freight will officially can launch its global expansion starting in 2019. Now, this is a company that's been in existence since 2017 and spun off from Uber in 2018. So this global expansion is something that we can look forward to. So per TechCrunch, the company plans to more than double its staff this year and is eyeing international markets. And according to the company itself, Uber Freight is lightening the load for carriers. It has upfront, no haggle pricing instant confirmed bookings and payments within 7 days of proof of delivery. From pickup to payday, Uber Freight app is touting its all-in-one tool to book loads faster. So lastly, we're going to take a look at our Disruptification Index, which continues to outpace major indices more than 2-to-1 year to date. As of Thursday, February 14th, it's closed, the index is up 22% versus 9% on the Dow and 9.5% on the S&P. So that's what I'm watching today. Ian, tell us what's on your radar.
Thanks, Amber. So I want to add a little bit more about that retail sales number because this was a huge surprise that caught the market completely off guard. And so a few reasons for that are because, number one, a lot of companies, big retail companies, reported after last holiday that they had great sales numbers. Target said they grew their sales 5.7% year over year. Amazon said they sold millions more devices than they did last year of their own Amazon brand. And MasterCard even said that people using their cards rose sales 8 to 9% in industries like apparel and home improvement. So these are huge parts of the retail industry that just don't match that number. And overall, it looks like the market didn't really even take that into account. Yesterday and today, the main retail index, XRT, is about even. So we're going to watch this going forward and see what happens in the market because this was such a surprise, but it doesn't look like too much is happening right now in the market. And another thing that I want to go over today is satellite internet. And this was a huge growth industry back around the era of the dot-com bubble. So the mid to late 90s into the 2000s, we saw companies like Iridium and Global Star all competing to be the first ones into space to provide satellite internet. And theoretically, this could be something that would be delivered to the whole world. So the internet at that time was new and it was very exciting, this possibility that we could beam down internet from satellites. But the problem back then was the cost of doing so was very high. These companies ended up going bankrupt or even completely out of business, and a couple have rebounded since then. But it's nothing like it was before, and the sales numbers just haven't grown in years. But now we're seeing some startups start to completely disrupt this index. So one of them is SpaceX, which is owned by Elon Musk, also owns Tesla. And SpaceX has a plan. They recently got approval from the FCC to send 12,000 satellites into space. And this would effectively give free Wi-Fi to the entire world. So their plan is to do this. They're going to send out their first batch this year. There's another company called OneWeb that plans on sending 600 satellites into space by 2027 to also provide Wi-Fi for the whole world. And this is a market that can see a lot of growth. There's a lot of room for opportunity because over 3 billion people in the world are without internet right now. So there's a lot of people that would benefit from this. And if they can make it so that the speed is competitive with things like cellular data, this could be a huge opportunity. And we're seeing venture capital firms pouring billions of dollars into these companies. So that's one of the main things that I'm watching for the kind of new economy that we're seeing emerging with the disruptification as our central theme. This is something that I believe could really make a difference. And another one that I'm watching is the sharing economy. So, or also called the collaborative economy. This is things like Airbnb, Uber, and Lyft, and companies like that, where people provide services of their own, like renting out their house or driving people as a taxi service, that could tie into the tourism industry, which right now on a global scale is around $11.3 trillion. And that makes up over 10% of the world's GDP. So if the collaborative economy, I believe this could make a huge difference. It could tie into the tourism industry that's multi-trillion dollars. And companies like these are also receiving funding from venture capital firms. They've gotten about $23 billion since 2010. Most of that's in the past couple of years. And we've also seen the emergence of e-scooter companies like Lime, which recently received a $310 million investment. This company is now valued at about $2.4 billion. So these are startups that have just popped up over the past year or two in some cases, and they're already worth billions of dollars. So these are a couple things that I'm watching for the overall disruptification of our current economy. And Paul?
Thanks, Ian. Great stuff from both you guys, Amber and Ian. So also to touch on the whole retail number, which when I first saw that, I said, well, that's definitely dissonant to what Ian, Amber, and I had been tracking until then, which is Ian said Target was up and even other retailers. However, some of it makes sense. And Ian, Amber, and I, we were having this discussion, which is that, as you know, at Bold Profits, the coming of age of the millennial generation is one of our themes, which is a sort of a facilitating theme. In other words, a new group of people who want new solutions, new ways of doing things, and are willing to shift from the old way to the new way. And Ian was telling us how this Christmas, something like 70 or 80% of his gifts were experiential gifts. And so we think there's also something going on here where there is disruptification of a different sort, where people are spending more money on hotels, restaurants, cruises, experiences of various sorts, instead of accumulating things. And this could also be one of the reasons, which is that millennial generation now represents a very significant part of the retail audience. Mm. And so if they're spending less, you're definitely going to see it. And in fact, I know quite a few millennials that actually largely don't even celebrate Christmas. And so their spending now just happens when they go on these experiences. So that's something to keep in mind, and something to keep in mind when you invest in retail. And we certainly keep it in mind because all of our retail stocks that we have in our services are definitely in the new world. They represent solutions to a problem, or else they give something that people really believe in, retailers that have a mission or have something to it that really causes people to want to buy these things. The other thing that was interesting yesterday, and we were having this conversation, is that we were looking at the Profits Unlimited equal weighted portfolio when the Dow was down a couple hundred points, and that portfolio was flat. So it really, really demonstrated to me that this idea that we have been telling you about, this old versus new, is really beginning to take hold in the markets. Invest in the old, and let's say you take example of like Coca-Cola. And we've done some analysis on Coca-Cola that shows that this is a company that's in deep decline and where their sales are going down by 7%. And that's what's pushing the Dow Jones Industrial Average down. And we, of course, we know that Coca-Cola is in decline because there's been a shift. People used to drink a lot of it, and it used to be seen as a staple. And now it's seen as something that causes obesity and causes metabolic diseases and diabetes. And so there's this shift. So this theme of old versus new is really, really getting stronger and stronger by the day, where the old is really beginning to show cracks and the decay in their businesses. And yes, they have these so-called super tanker balance sheets. However, I would tell you that's an illusion. They also pay they have these extensive track records of paying dividends. However, there's no way you can continue to pay a dividend if your business is in decline. On one level or the other, you should either be reinvesting for the future, or else you're simply managing your decline. So the last thing I'll touch upon is that there's also this idea going on, which I see a lot out there, which is this term called the earnings recession. And I want to simply give you a sense of what people are talking about when they mean this. So there is, according to strategists, in other words, these are people who use macro theory to come up with predictions. They believe that the earnings estimates and the earnings for companies are going to go down in 2019. And you know what? There may be something to it. However, it's really as much about the old versus new, which is that the S&P 500 is stuffed, especially the top portion of it. In other words, the biggest companies, Coca-Cola, for example, these are old world companies that are going to see earnings declines, that are seeing sales declines. And so this is not an earnings recession. This is going to be eventually a permanent wipeout. And I can only leave you with this, which is something I go to all the time. This is a time of incredible, unbelievable opportunity if you are in the right stocks. However, invest in the wrong stocks, and this is a time of incredible peril. Incredible peril. You could be in what you might think is safe. However, it could be the most dangerous thing. So that's all I have. Back to you, Amber.
Thank you so much, Paul, for sharing those insights with us today. And thank you, Ian, for your insights as well. And thank you to our listeners for tuning in. We look forward to speaking with you again next week. And until then, have a wonderful day. Take care.